Hello everyone, welcome to Sole Trader Final Accounts. This is video lecture number 2, and in this lecture we're going to be looking at the accounts of Anne Smith, who's a sole trader, and we're going to look at her second year in business. In video lecture number 1 we looked at her first year, so the second year ends on the 30th of June 2020. And here we have a list of what occurred during that year in Anne's business, what transactions took place. So I think the first thing we'll do is we'll see, we'll draw just a timeline, maybe a timeline for the business. So here's our year, if you like. So here's the start of the year, here's the end of the second year. So let's put dates on this just to be sure we know what kind of time period we're talking about. So the year we're interested in is from the 1st of July, okay, to 2019. Sorry, 2019, and the end of the year, of course, is the 30th of June, 2020. So this is the second year in business, and as before, we're given, well, as always, really, we're given 2 sets of information in order for us to do these accounts, these final accounts for the business, these financial statements for year 2. And the 2 bits of information are as follows. The first thing we're going to be given, the first bit of information we're going to be given is about opening balances, or at least the first bit of information we need are about the opening balances. And the second piece of information is about the transactions that have occurred during the year. Okay, what transactions occurred during the year? So in relation to the opening balances, we're not actually given any information here about the opening balances, but so we have to rely really on the accounts that we did in her first year. So when we were doing our accounts in the first year, we ended up with a balance sheet, if you like, at the end of June 2019, and that's where we're going to find the opening balances. So we have to go back, okay, when we're doing the accounts for the second year, we have to go back to the accounts that we did probably a year earlier and look and see what were the closing balances last year, and they will be the opening balances this year. And of course, where we find the closing balances are in the balance sheet at the end of last year. So that's where we're going to find these opening balances. The balance sheet, let's write that in here, the balance sheet at the 30th of June 19. Previous year's balance sheet, and there we'll find what at this date, at the beginning of the year, what equipment was there in the business, what money was in the bank, what did the debtors owe, what stock levels were there, and how much what debts did the business have, and so on. So that's where we're going to find that information. And in relation to the transactions, okay, in this case we're not looking at individual transactions, we're looking at a summary of the transactions that occurred during the year. And where we go and find that information, I suppose, are in the books of the business. Okay, are in the books. So what we have over here, if you like, all over here, is a summary of the books, essentially, of the business. So let's have a look at what those transactions were, and then we'll go back and we'll try and find out what the opening balances were, and we'll see how we do that. Okay, so let's just read down through these transactions that we have during her second year. Well, the first summary of transactions, I suppose, are the credit sales. So during the year, Anne's business sold to its customers 120,000 euros worth of goods on credit. Okay, and when they made these sales, they sent out invoices, or Anne's business sent out invoices to these customers, and kept a copy and wrote the details of these invoices into a book called what we call a sales book. And at the end of the year, we add up that sales book, and that's where we get the 120,000. Okay, the same thing with the credit purchases. Anne's business purchased goods, stock during the year, and received an invoice in respect of each purchase, and wrote the details of that invoice into a book which we call the purchases book. We add it up at the end of the year, and that's where we get the 60,000. Okay. The next, so that's sales and purchases. The next type of transaction we have are cash received. So Anne's business received money during the year from the debtors, from the customers, 96,000. So there's a kind of a relationship, I suppose, between those two transactions, in that they're both transactions with the customer. Okay, we sell these goods. The goods that were sold to the customer had a value of 120,000. That's what they were sold for, and the cash received from the customers are 96. So obviously the customers owe a certain amount at the end of the year, and we saw in the first year what we simply did was subtract 96 for the cash received from the credit sales. But in this case, we do have to take account of the opening balances. So at the beginning of the year, the customers would have owed some money, so we were going to hopefully receive that in the second year, and then the business sold a further 120,000 and received 96. So we've got to work out essentially what's owed by the customers at the end of the year. Okay, so that's a calculation we're going to have to do. The next types of transactions are, okay, so we've got sales, purchases, cash in, cash received from the debtors, and now cash out or money out of the business. And we do this in another book called a bank, a bank payments book or whatever. And this is a summary of the bank payments. So the first bank payment that Anne's business made was 43,000 to the creditors gradually throughout the year. Okay, so there's a relationship between that figure and this one up here. Okay, so the credit purchases, that was what was purchased from suppliers, and these payments then to the creditors are suppliers, are the same suppliers. So in the first year we didn't have any opening balance, so we would have just subtracted these two figures from each other. But because we are in our second year now, we will have an opening balance, so we have to take that into account when we are calculating the creditors at the end of the year. Okay, so that's that. So the next bank payment then, we're assuming here all the payments that this business makes are made through the bank, some kind of bank transfer or check or something like that. That's the assumption here. And we're assuming all the cash that's received is also lodged into the bank. Okay, then we have some expenses. The total of these expenses are 54,000. And we have a breakdown here of what those expenses were. That's important, that breakdown. When we're doing our profit calculation, we'll need that. Okay. Now we're going to assume that all of these have been paid. Okay. There's no outstanding amounts that haven't yet been paid. That's just an assumption we're going to make. Now the loan repayments. Now remember, there was a loan last year, so that loan hasn't gone away. It's still there. There's still a balance on the loan at the start of the year. And she paid, or the business paid, 3,000 in loan repayments during the year, and that included 900 interest. Okay, so I can't remember what the balance was. I think it was 8,000 on the loan at the beginning of the year. We'll look at that now in a minute. And so she was charged some interest for the second year, and then the loan repayments were 3,000. These are more bank payments then down here, drawings. These are amounts paid to the owner of the business. Okay, and that's that essentially. So they're the transactions. So the bank payments really are those four things there. Okay, those four things are the bank payments. And the closing stock here is not a payment, or is not a transaction, of course. The closing stock is just the value or the cost of any unsold stock left in the business at the end of the year. So these are purchases of stock that haven't yet been sold on. And one of the rules of accounting is that we don't include this closing stock as an expense this year. So we're going to deduct this closing stock from the purchases figure when we're calculating our profit. But we won't include it as an expense this year, but next year we will, when we sell it. So accountants like to compare like with like when they're calculating profit. So they're going to compare the revenues from the sales, okay, the 120, with the cost of those sales, okay, not the cost of the purchases, but the cost of the goods that were sold. So we're going to make what's called an accounting adjustment with this, okay. We're going to adjust the purchases figure, so we're going to make an adjustment for that. Okay. Right, okay, so there are the transactions during the year, okay, and now we'll go and we'll have a look and see, well, what were the opening balances. Now remember the purpose of all of this, why we're doing these accounts, okay, we want to find out a number of things. I'll just put down here what these things are. I suppose we want to find out what the profit of the business is. That's the purpose of accounting. That's why we're doing these final accounts or financial statements. So we want to know, well, what is the profit, okay? And you know, we work that out in a what we call a profit and loss account, okay? But of course, the profit can be expressed as an equation as well, and the profit equals, I just say R minus E. So the P is profit, R is the revenues, and E is the expenses. So we've got to work out, okay, what are the revenues and what are the expenses, and we calculate our profit that way. The next thing we want to do is, and we want to calculate the profit for the whole year, okay? So it's revenues, which would be sales, and then the various expenses, and we'll see what they are. Okay, now there's rules as to what constitutes a revenue and what constitutes an expense. We'll look at that now in a minute. Okay, so let's go on now to the next purpose, the reason we're doing this, and this is to work out what the solvency of the business is. The solvency of Anne's business at the end of the year. And here, when we're looking at solvency, of course, we're looking at the assets of the business. What does the business own at the end of the year? Okay, and we're going to subtract from that the liabilities of the business, what the business owes. And that should equal the capital of the business, what the business owes to the owner. And of course, we're going to do that in a balance sheet, okay, as you know. Okay, so that's essentially, these are the two things that are being asked really of us. So we're being asked to prepare the trading profit and loss account, that'll do number one, and for the year ending 30th of June 2020, and a balance sheet at that date, and here's number two. Now, in the course of doing the balance sheet, of course, we're going to look at or calculate another measure that's really important for accountants, okay, in the process, and that's what we call the liquidity of the business. Okay, so we're going to have a look at the liquidity of the business, and the liquidity of the business, I suppose, could be calculated as an equation as well. Okay, and the equation is just cash in. What cash is going to come into the business, and in this case we're going to put all the cash into the bank. Okay, let's assume that's kind of good business practice. So any money that they receive from whatever source, they're going to put into the bank, and we're going to subtract from that the cash out. Okay, the cash out, and we're going to assume that all money coming out of the business comes out of the bank. Okay, and that should equal some kind of a surplus if there's more cash coming in, or a deficit if there's more cash going out. Now, of course, because this is the second year, okay, we're obviously going to have some cash in the bank at the start. So we're going to have a surplus or a deficit at the start, or if you like, an opening balance at the start. So I suppose what we could modify this equation and just say that we're going to put in the opening cash, the opening balance of cash. Okay, so we're going to start off with what that is, whatever the balance in the bank is, and we're going to add that. Then we're going to start off with that, and then there'll be cash coming in on top of that, and then there'll be cash going out, and that'll give us a surplus or a deficit at the end of the year. So these are the three kind of measures that we're interested in. Okay, that we're interested in accounting. So I suppose we're talking about profitability, solvency, and liquidity. Okay, so let's do it. Okay, let's do the final accounts, or the financial statements of the business. The first thing we have to do, I suppose, is we're going to check out what the opening balances are, and we said that's going to be our starting point for doing these accounts. Okay, and to do that, we said we have to go back to the balance sheet of last year, which we did, of course, in video lecture number 1. Sole Trader Final Accounts video lecture number 1. So have to go back there. So we're going to take the balances out of that balance sheet, And what we do is we put them in a special document, okay, special document, and we call that document an opening trial balance. So let's do the opening trial balance. So all we're going to do with these opening trial balances is make a list of the balances, okay, the balances of assets and liabilities at a certain day. And I suppose the date of the balance sheet was the 30th of June 2019, but they'd still be the same on the 1st of the 7th, okay, the 1st of the 7th, hold on, I'll rub that out. Okay, so on the 1st of the 7th, 2019, these balances would still be the same, intact. So, you know, at the close of business on the 30th of June, the balances would be the same as the opening of business on the 1st of July. So what are we going to put into this opening trial balance? Well, what we do is we put in a list of debits. Now remember, debits in this context just means left-hand side, okay, and credits are just right-hand side. So we're going to deal with this later when we're talking about the system of double entry accounting. But from our knowledge so far of doing T accounts, we know that debits are on the left-hand side and credits are on the right-hand side. And in the balance sheet, the only debits that we have are assets. So we're going to make a list of the assets that were in that first year's balance sheet and liabilities, which are always credits, okay, on that side. And everything's in money. So let's put in the figures that we have, if we can remember them, from the first year's balance sheet, the balance sheet at the end of the first year. Well, I suppose we had some equipment. So if you remember, in the balance sheet last year, the equipment was purchased for 20,000, okay, and there was that was the cost of the equipment. But of course, by the end of the year, we had depreciated that, had reduced its value for wear and tear and so on by 4,000. Now, 4,000 depreciation put in there, it's not a liability, of course. It's a reduction in the value of the equipment. So the only place to put it, I suppose, is over here. So we've got the cost of the equipment here, a debit, that's the asset, and then a minus asset, or a reduction in the value of an asset of 4,000 there. Okay, any other assets? Stock. So there was some closing stock last year, which will now become the opening stock this year. So we put that in, it's an asset, of course, so it's on the debit side. The debtors is the next one. Okay, and I think we said that the debtors were 20,000, and of course debtors are an asset, it's a debt owed to us, to the business, okay, so if any debts that are owed to the business, to ourselves, is, as far as we're concerned, is an asset. If it was a debt owed by us, it would be a liability, of course. And there was money in the bank at the end of last year, and that was 15,000, and that's still there at the beginning of the second year. There was creditors, okay, in the balance sheet as well. And the creditors is a liability, money owed to suppliers, so it's 8,000. And the loan from last year is also 8,000. I think we said it was a lot of 8,000s in this question, but that's just a coincidence. And the only other thing then, the only other figure in the balance sheet, the only other closing balance, if you like, in the balance sheet is the closing balance of capital, and we worked that out, I think, to be 43,000. Now I'm just getting these figures straight from the balance sheet of the previous year. The balance sheet on the 30th of June 2019, and this is the opening situation for the second year. So we're going to add all those up, okay, and what do we get? I'm just going to bring this down a little. Going to bring the thing down. So when we add it up, we get, I think that comes to 63,000 on both sides. I hope. Yeah, I think it is 63,000 on both sides. Now, that's not a very important document, you know what I mean, it's just something we do, we're just our starting point. So when we're calculating our bank, for example, we'll just refer to this document and say, okay, there is an opening balance in the bank, there is an opening balance in the debtors, and so on. Okay, so it's just our starting point. So we didn't do this in the first year, of course, because there were no opening balances. It was a brand new business. But in the second and subsequent years, we have to do this. Okay, so what are we going to do now? Okay, well, probably now what we have to do, I suppose, is to calculate the profit, calculate the in the profit and loss account, calculate the balance sheet, and so on. And I think what we will do is, before we do any of these statements, if you like, these financial statements that are kind of published, at least in a limited kind of way, they'll be sent maybe to the revenue commissioners, or maybe our bankers might like to see, Anne's bank manager might like to see her profit and loss account and her balance sheet. So there'll be a limited kind of publication of these documents. But before we actually do those parts of the accounts, maybe we'll do all the necessary calculations that we have to do, okay, before we actually do the accounts. So let's have a look and see what we need to do. So the first thing we've got to do is the profit calculation. So let's have a look at that. Okay. So we said that the profit calculation, we said that when we're calculating our profit, we can calculate it as an equation. So let's see, do we have all the necessary figures first before we actually do the profit and loss account. So we said the profit equals revenues minus expenses. So what do accountants consider to be the revenue? Okay, the revenue, well, what accountants regard as the revenue is not the cash in, okay, not the cash that is received in the period, but what is actually sold in the period. So in this example, we're going to include as revenues 120,000, even though this money has not yet been received in full. Okay, so that's just one of the rules of accounting. A sale is a sale whether or not the money has been received. Okay, that's just the way it is. The next thing then are the expenses. Okay, so let's see what the different expenses would be. The first expense is what we call the cost of goods sold. So those sales, these sales over here, these goods that were sold, what did they cost? Okay, what did they cost Anne's business? So we've got to try and work that out. And the problem, of course, is that we don't keep a record, an ongoing record of the cost of goods that we sell. Okay, we keep a record of the cost of goods that we buy. So we're going to have to adjust. We're going to have to, do a little calculation, if you like, to find out what is the cost of these goods that were sold. Well, first of all, what goods could have been sold? Well, the first goods that may have been sold in the sales there would have been the opening stock. Okay, I'll just put an equal sign, would have been the opening stock at the start of the year. So they were maybe part of these sales. So what was the cost of the opening stock? It was bought last year, and we know from our trial balance here that the opening stock was 8,000. Okay, so maybe that probably the opening stock was part of what was sold in the second year. Okay, also potentially what was sold during the second year was whatever was purchased during the second year. Okay, what we call the purchases. Now if we go up and have a look again and see, well, what were the purchases? Okay, we can see there that the credit purchases were 60,000. So they may have been sold, some of them at least. So the purchases are 60,000. Okay, so the total of the purchases that could have been sold was 68,000. Okay, that the business had the potential, if you like, to sell these 68 goods that cost 68,000. But of course, we know that not all of these goods were sold. That some of them were left unsold at the end of the year, which we call the closing stock, and we're not going to include those as an expense. So we're going to deduct, if you like, the closing stock, which is 18,000. I'll put it in brackets to indicate we're going to deduct it, and that gives us 50,000. Okay, and that is the cost of sales, the cost of goods sold, and that's how we calculate. So essentially we have a formula, I suppose. So it's the opening stock plus the purchases minus the closing stock equals the cost of goods sold. Okay, and that is our first expense. Okay, that's one of our expenses. That's what we're so we're not interested as an expense when we're looking at our expenses. It's not the cost of the purchases we put in, the cost of the stock we purchased. We're more interested in the cost of the stock that we sold. Okay, and that's what we compare with the sales, the revenue from those sales. Okay, what other expenses were there? Okay, well, there were a list of expenses there. Let's just go up and see what they were. Okay, there's a list of expenses. I'll just put it up a bit quicker. Okay, so there's our expenses. There are various things. I'll just put in there that the expenses are 54,000 at this point in time because we're only doing the equation. So the next expenses that we're going to include here are, expenses. So the expenses are 54,000. Okay. Now, are there any other expenses? Well, there are in this example, right? Because there is a loan, the business paid in the second year loan interest, and that is also an expense. So the loan interest this year, 900. And finally, then the only other expense is depreciation. There was depreciation in the first year on the machine we bought for 20,000 in the first year. The depreciation is a rate of 20%. So again, it depends on the method of depreciation we're using, but the most common method of depreciation is known as the straight line method of depreciation. And this takes 20% every year of the original cost of the fixed asset, whatever that was. And we know the asset that was purchased was equipment, and it was 20,000 euros. So a fifth or 20% of that is 4,000. So in the first year there was depreciation of 4,000, and so also in the second year. Okay, so there's the expenses. So what have we got? We've got expenses of 50,000. Which is the cost of sales. That's our first expense. Then we've these miscellaneous, a number of different expenses just bundled together there, 54,000. We've the loan interest, and we've got depreciation as well. Okay, now I think that adds up to, is there anything else? 54,000, no, I think if we add all of those up, what do we get? I think we get, well, let's just get a calculator here and let's add it up. Okay, so we've got 50,000, okay, 54,000, we've got 900, and we've got 4,000. So a total is of 108, okay, 108,900. So the total of the expense is 108,900. So there's our sales over here, okay. And here's the various expenses over there. So when we subtract one from the other, of course, we get what the profit is. And the profit is, well, let's work it out. So it's 108,000 and the sales are 120. So the profit, if you like, is 11,100. Okay, so we worked out our profit using an equation, very easily done. So there's no real other, calculations to do on this. Okay. Normally, what we would do is we'd work out these. These might be more difficult calculations than in this particular example, and we would open up a T account to work out what the sales were. Open up a T account for the purchases and a T account for all the expenses. And accountants do all their calculations in these T accounts or ledger accounts. But I think in this example there's no real need to do that. But bear in mind that that's what normally we would do. Okay, so before we actually go on and do the profit and loss account itself, let's see how we might do the balance sheet. Okay, let's see how we might do the balance sheet as an equation. Okay, so our balance sheet expressed as an equation will be as follows. Okay, what we're going to have in the balance sheet are assets. We're going to have liabilities, and when we subtract those two from each other, that gives us the capital or the equity in the business. We just call it capital. So remember, what the assets are what the business owns. Okay, the liabilities are what the business owes, and the capital is what the business owes to the owner. And we're going to do this. This is sometimes referred to as the accounting equation, but essentially it's a balance sheet expressed as as an equation. Maybe I'll just write that in, the accounting equation. Okay, it's called the accounting equation, not too important, but I'm just using this accounting equation to try and explain, the different elements in a balance sheet. And we're going to do this accounting equation at the end of the year, at the 30th of June 2020. So we're going to try and find out now what assets are in the business at that date, what liabilities are in the business, what capital. So let's do that. Okay, the first asset we could look at is, I suppose, the equipment. So how much will the equipment be worth now? Now remember, this equipment originally was purchased for 20,000. I'll just put in 20k. And in the first year, you might remember that there was 4,000 knocked off the value of it. Okay, we reduced the value of the equipment by 4,000 for depreciation. And now, in the second year, we decided we're going to do the same thing. So another 4,000 is now going to be deducted from the value of the equipment. So the total depreciation to date is 8,000. Okay, the cost of the equipment is 20. So what we call the net book value, and that's what we're interested in, the net book value of the equipment is going to be, what is that, 12,000, 12k. And that's the figure we're interested in. Okay, this is the figure that we're going to put in our balance sheet. That's what it's worth, we believe, or at least that's our best estimate of what the equipment is worth after 2 years. Okay, what other assets do we have? Okay, well, we've got the stock, the closing stock at the balance sheet date. Okay, at the balance sheet date, the 30th of 6th, 2020, what is the stock? Well, we call that the closing stock. And I think we said that the closing stock is 18,000. That's given in the question. Okay, and we would find that out by doing a stock take into business at the end of the year. Just add up all the stock, find out what it cost, and make a list, and that's it, the 18,000. The next figure, asset figure we're going to put in the balance sheet is debtors. Now we want to know how much do the customers owe at the end of the year. Now this is something we're going to have to calculate. We're going to have to take account of, well, what was owed at the start of the year, how much did the customers owe at the start of the year, what did we sell to our customers during the year, what did they pay us during the year. So that is a calculation. So that needs to be done, okay, before we can actually do anything else. Okay, before we can do the balance sheet for sure, we really have to work out what the debtors are at the end of the year. And how we do that, of course, is using how accountants do it, is they prepare what's called a ledger account or a T account, and that's what we're going to do shortly. Okay, but let's see, is there what other figures we need. So while we didn't need to do any T accounts for the profit calculation, we do need to do them for this balance sheet that we're going to do. The next one is the bank. Okay, so we've got to try and work out how much money is in the bank, if any. Okay, and again, we don't know. Okay, we know what was in the bank. We do know what was in the bank at the start of the year, 15,000. And okay, we could find out pretty easily then what came into the bank during the year from our customers or wherever, and what went out. But it is something we're going to have to calculate. Okay, so we're not really in a position to figure out at the moment anyway what the total of our assets are. We've got these two calculations to do. The liabilities then, we're going to have creditors. So we want to know at the balance sheet date how much did Anne's business owe the suppliers, okay, the suppliers of the business. And again, we don't know it. We know how much was owed to the suppliers at the start of the year from last year's balance sheet, 8,000. And I suppose we know how much was purchased then during this year and how much was paid to these creditors during the year. So it's not a difficult calculation, but it is a calculation we're going to have to do, and we'll do that in another one of these T accounts. Same thing for the loan. Again, we want the loan balance, how much is owed on this loan at the end of the year. We don't know for sure. Okay, we know what it was at the start of the year, 8,000. but again there was some interest charged by the bank or the lender, and some repayments were made. So again, not a difficult calculation, but a calculation that has to be done all the same. Let's look at the capital then. Okay, how are we going to work out the capital? Okay, well again, how we work out the capital, against the capital at the end of the year, we're going to start with the capital at the start of the year. Okay, the opening capital, how much was owed to the owner at the beginning of year 2 or at the end of year 1, and that of course is 43,000 is the opening. Okay, that's what was owed to the owner by the business at the beginning of the year. How did we get that? Well, I think what we said was there was last year what happened, she invested some money, so that includes some of the money she invested, I think it was 20,000 or something like that, into the business, and the other 23 then is what we call retained profits. Okay, so the business made profits last year, and some of those profits were given to the owner, but most of them weren't. 23,000 wasn't. So we added 23 into 20, and that's how we got the opening capital. It's just from last year's balance sheet. And what we're going to do is we're going to add then to that, okay, we're going to add to that the profit of the year. I'm going to add, I'll just put in there, the net profit, because the profit belongs to the owner. So we always add profit onto the opening capital. Now we do know what it is. Maybe we just put that in, because even though we haven't done the profit and loss account, we worked it out here, so we might as well put it in. So the profit was 11. So I better I'll do the full figures here. I just won't use K here because I need to show the whole thing. So 43,000 was the opening balance. The profit was 11,100. That's right, 11,100. But however, there was drawings. Okay, so say less the drawings. So if you like, some of the capital was given back to the owner, and the drawings were, well, let's check, what were they? 20, I think. Okay, let's just go back up and see what they were. The drawings were 20,000. Okay, so let's go back. So the drawings then were, so I suppose these drawings that were taken out 20,000. What was given to the owner, I suppose, was all the profits, if you like, and plus some of the capital. Okay, so I'll just put that in brackets there. Okay, so we'll add all that up. Okay, and when you do that, 43 plus 11,1 minus 20, that comes to 34,100. So we're able to work out, we didn't need any further calculations to work out the capital, so that's that. So we're not able to do the balance sheet yet, because we still need to find out what the figure for debtors is, the figure for bank at the end of the year, the figure for creditors, and the figure for loan. And as soon as we do those 4 figures, then I think we have enough information to do the balance sheet. Okay, so I think what we'll do now is we'll actually work out what these figures are before we do any of the final accounts. Profit and loss account, we'll do that at the end. We'll do all our calculations first, and where accountants do this is in a place called the nominal or the general ledger. Okay, the general ledger, the nominal ledger. And normally what the nominal ledger is it's a collection of these T accounts that accountants are using to do the calculations, and it's one T account for every figure in the profit and loss account and balance sheet. So every single figure in the profit and loss account and balance sheet has its own T account, and so there could be quite a number of these T accounts to do then. So there'll be one for sales, one for purchases, one for wages, one for rent, and so on, and then one for debtors, and one for equipment, and one for depreciation, and one for us, and so on. Okay, every figure in the final accounts has its own T account in the nominal ledger. Now I'm not going to bother doing all these T accounts, I'm just going to do the ones we need. So I'm going to do a kind of an extract of the nominal ledger. So what we're going to do is going to do a T account for debtors, for bank, for creditors, and for loan. I think I might do the bank first. So let's have a look and see how that's going to work out. Okay, too far. Okay, so we're going to do a T account for the bank. So maybe I'll just call this what it is. We're going to look at the nominal ledger. As I said, it's also sometimes referred to as the general ledger. Might as well put that in. And I'm not doing the whole thing, so I'll just put in here an extract, okay, meaning a bit of it, okay. I'm going to do a little extract from it, okay, so that's what we're at here. Okay, so let's do the T account for the bank. Okay. So we give it the name bank, okay, bank account maybe, and we have a debit side. I just put the word debit over here because debit is the left hand side and credit is the right hand side. Okay, so that's what we're going to do. And remember what we said when we were doing this for the first year, the cash in goes in on the left on the debit side, and the cash out goes in on the credit side, the right hand side. So let's start off. The first thing we have to do with this bank account is to put in the opening balance. And the opening balance is in our list of balances up there above, which is the opening trial balance. So we're going to put in here on the 1st, we put in the date, on the 1st of the 7th, 19, the balance, or the opening balance, was BAL just, and the opening balance was 15,000. So that's our starting point. We always need to put in a balance at the start. So if there's money in the bank, it's an asset, so it'll be on the debit side. But if this happened to be overdrawn, of course, it'll be over here on the other side. Okay, but we know that there was money in the bank at the start of the year. And what we're going to do now is look at what cash came in during the year. And there was only one type of cash flow came into the business, and that was from the customers, or if you like, the debtors during the year. So I'm just going to put the word debtors. So there's lodgements, if you like to put it that way. Money was lodged into the bank account. It came from the customers, from the debtors. So that's a 96, I think we said, 96,000. So that's it. There's no other cash flows coming into the business. No, the owner didn't put any money in, or no money was borrowed to put in, or anything like that. We didn't sell any equipment or anything like that. The only money coming in is from customers. And now we make a long list now of the different cash flows going out of the business. So I just put them in any particular order. It doesn't really matter. So these are the bank payments in the question. Okay, so we're going to put in there the creditors, 43,000. I'll just go through these very quickly. So creditors were paid, and then these expenses, I'm going to list them out individually. The wages were 40. The rent was 10,000. The insurance was 1,000. The motor expenses, this would be fuel and motor insurance and motor tax and repairs and things like that. Motor expenses, I just put EXP, 2,000. The telephone, the telephone bills, all of these were paid, okay, 1,000. And then they're the expenses. So I think when we add up those 5, I think they come to 54,000 or whatever. And then the next one is the loan. There was some loan repayments, so that must have come out of the bank as well, to pay off the loan. And then there was some drawings from Anne herself. She just took it out of the bank, and that was 20,000. Okay, so now we have all the cash flows in, 96, all the cash flows going out, whatever these are, add up to, and we've got the opening balance. Now I'm just going to get rid of that there for a moment. Didn't want to do that. And so what we're going to do is we're going to see which side is the highest side. Okay, so let's add up the left hand side. I'll just do it here. Okay, if we add up the left hand side, I think that comes to 111,000 when we add those up. Okay, and when we add all these up, okay, they come to 118,000. So you can see there's more going out than was either there or coming in. So what we do, how we do this T account is we pick the highest side, Okay, we picked the highest side. I'll just go down a little bit. And the highest side is the 118,000, obviously, and we total it up. Okay, and we say, okay, the total was 118,000. And we go over to the other side, which only adds up to 111,000. And we say, okay, we're going to make that 118 as well. So both sides are whatever the highest side was. Now the right hand side is fine, the left hand side isn't. Okay, so there's a missing figure or a balancing figure, and the difference between 111 and 118 is 9,000. So we have to put the 9,000 so it adds up. And what do we call that? Well, we're going to call that the balance at the end. The 30th of the 6th, 2020, that's our new balance. And we're going to do one final thing. We bring the balance over here. 1st of the 7th. Okay, the 1st of the 7th, 2020, the new balance, we bring it down on the opposite side, 9,000. So we're ending up with a credit balance for next year. Okay, for year 3, we're going to start year 3 with 9,000 of a balance, but you'll notice it's a different balance to the one we started out with. This was a debit balance up here, and here is a credit balance. So the credit balance therefore indicates that it's a liability, and therefore it's now overdrawn. The bank at the end of the year is overdrawn, and it'll be overdrawn at the start of year 3. So the bank is a peculiar kind of figure, if you like. Sometimes it's an asset, usually is an asset, but sometimes it can be a liability as well. Okay, so we'll work that out when we get to the balance sheet. The next thing we've got to do is the next T account, and the next one is the debtors. Okay, so this is a bit easier, not so many figures. So we call it a debtors account, and again we've the debit side. Very often you see the letters DR for debit and CR for credit. Okay, so I'll just do it that way. Okay, now again with the debtors we want to find out what's the closing balance of the debtors. So we start off with the opening balance of the debtors, and the balance of the debtors at the beginning of the year was again it's an asset. Okay, so it's on the debit side. 1st of the 7th, 19. The balance was 20,000. Again, we had these opening balances. Right, okay, so we start off with the customers owing 20,000, and we sold them, or Anne's business at least, sold them some goods during the year. So we put that in, the sales, on credit. These are all credit sales, of course, 120,000. Okay, so Anne's business is due to pay us the 20 from last year and 120 from this year's sales. What did they pay? What did these customers pay? Well, we received and put in the bank, remember over here, the 96,000 we got from them. And that's it. They're the only 2 transactions in this one. Okay, so we add up both sides. The left hand side is 140, the right hand side is 96. We pick the highest figure, and that's 140. That's what we do. Make that the total of both sides. Now the left hand side is fine, the right hand side isn't, so we put in the new balance then, the 30th of June 20. The balance is, just squeeze it in there, the balance is 44,000. So at the end of the year, Anne's business is owed 44,000 by its customers, and that's what we were going to do. We're not going to do year 3, of course, but if we were going to do year 3, we would have an opening balance then on the 1st of July 20, and the opening balance starting off year 3 would be 44,000. Okay, so that's the debtors. We've 2 more to do, the creditors and the loans. So let's do those. Okay, so we put in the creditors here. So again, these are just T accounts in the nominal ledger. Because a creditors account, and again we have a debit side DR and a credit side CR. Now, okay, we want to find out how much is owed to the creditors by Anne's business at the end of the year. But we start off with what's owed at the beginning of the year. And now this is a liability. Creditors are a liability, different to the previous 2. So the balance therefore is going to be on the right hand side, or the credit side. So let's put it in. 1st of the 7th, 19, the balance is, well, what was it? 8,000. Again, from our trial balance, our opening trial balance, which came from the balance sheet last year. So that has to be paid. Okay, that's money owed from last year, so that's going to have to be paid by Anne's business in the second year. And what else is going to have to be paid? The purchases. She purchased stock. The business purchased stock 60,000. That's that. Okay, but of course Anne's business paid some money over to the creditors, and that came out of the bank, and that is 43,000. Okay. So again, pretty easy. Just an opening balance. What did we buy? What did we buy in stock from the creditors? What do we pay the creditors? What do we owe the creditors at the end? You could do it in your head, but as I said, accountants always use these T accounts for all calculations. That's just the way it's done. Okay, so what have we got? The right hand side is 68, left hand side 43. We make both sides 68. Sorry, make both sides 63. No, 68. Okay, 68. And the missing figure, therefore, when we subtract 43 from 68, is of course 25. So Anne's business owes the creditors on the 30th of the 6th 20. Okay, the balance, that's the balance owed. Right, one more calculation to do. Okay, we do it over here, and it's the loan account, and we want to put in our balance sheet the balance in the loan at the end of the second year. So let's try that. Okay, so again, it's a liability. Okay, the loan is a debt owed by the business. It's owed by the business. Excuse me, and so we put in the balance. So on the 1st of the 7th, 19, the balance on the loan, if you remember, was 8,000. Now, what adjustments or what happened then with the loan in the second year? Well, not much. No new money was borrowed or anything like that. All that happened in the second year was that the bank or the lender charged Anne's business interest. And you know what happens with interest? You just add it on to the loan. Okay, so we just put in here loan interest. Okay, and the loan interest was 900. So now if Anne had not paid anything off in the second year, she would owe 8,900 at the end of the year. If there were no loan repayments, she would owe 8,900. But of course she did make payments. Okay, through the bank, she made payments of 3,000. Okay, so we're going to deduct that from the loan then. So now, okay, that 3,000 then, I suppose 900 of it went to pay off the interest first. I suppose the bank would always allocate payments to the interest first, and the other 2,100 would come off the principal. Okay, add up both sides. The left hand side is 3,000, right hand side is 8,900. Pick the highest figure, 8,900. Okay, so the missing figure clearly is then, there's a missing figure on the debit side, and that missing figure, of course, as before, 30th of the 6th, 2020 is, what is it? What is that? 5,900. So that's the balance left on the loan to be paid in subsequent years. Okay, and we bring down the balance. Very last thing we do, we bring down the balance, and it's a credit balance. Okay, so on the 1st of the 7th, 2020, the balance is 5,900. So you can see here then what the balances are like. We're ending up, if you like, if we're just looking at these four T accounts, that 3 of them are ended up with a credit balance. Okay, the loan, the creditors, and the bank added up. I forgot to bring down the balance with the creditors here. Might as well do that. 1st of the 7th, 20. The balance is 25,000. So with the creditors, we ended up with a credit balance. With the loan, we ended up with a credit balance, and with the bank, we ended up with a credit balance. So we've got 3 liabilities really. Okay, and there's just one asset up here, that we have, and that is the debtors. Okay, so if we go back up to our equation, our accounting equation, we're now in a position to fill in the missing bits. Okay, so let's do that before we actually do the balance sheet, to make sure that the thing balances. Might be a good idea. Okay, so the debtors, we now know what the debtors are. I'll just rub these out here. Okay, we know what the debtors are. The debtors, we said, were 44,000. Okay, and the bank, well, there is no bank on the asset side anymore. Okay, because remember we said that the bank balance is 9,000 overdrawn, so we're going to get rid of it there. Okay, we don't want it there anymore. Okay, so we get rid of that because there's no money in the bank account. And what we'll do is we'll put it over here as a liability over here. We just say bank. Well, we won't call it bank. We call it bank overdraft. And the bank overdraft, I think we worked out to be 9,000. Okay, so that's the bank done. Then we go and we look at the creditors, and we can fill in the creditors figure. And I think and I'll get rid of the loan as well. Okay, and the creditors from the T account, I think we said that the creditors were 25,000. And the loan was, well, I'll write the whole thing out, 5,900. Okay, so let's add these up then. Okay, I'll just get rid of that. Nope, wrong one. Okay, so what did they add up to? Well, we've got 12,000. Okay, 12,000 is the equipment. The stock is 18, and the debtors are 44. So if we add those three together, what do we get? I think we get 74,000, if I'm not mistaken. 74. I'll put in the full number. 74,000. And if we add up 25,000 and 5,900 and 9,000, and if we add those up together, we get 39,900. I hope that's right anyway. Okay, and then when we subtract the liabilities from the assets, that should equal the capital over there, 34,100. Okay, so now we know the figures that are going to go into the balance sheet. Here are the assets, the liabilities, and the capital. So we've done our nominal ledger, our bits of it. Well, first of all, we did the opening balances and the opening trial balance. We did the necessary calculations in our nominal ledger. Okay, and now we can go ahead now and do the profit and loss account and the balance sheet. Okay, profit and loss account. We have all the necessary figures. So I'm just going to move it over to the right, I think, and up to the top. Okay, too far. Okay, so the first thing we're going to do then is we're going to do the profit and loss account, the trading profit and loss account, which, as I said, is published at least to a limited degree for a sole trader. You might send it to the bank or the revenue commissioners or whoever. Okay, you might send it to different people. So let's do the trading profit and loss account. First thing you always put in is the name of the business, and it's a sole trader, so therefore we put in just the name of the person who is the owner. Okay, now sometimes sole traders, I might have mentioned this before, sometimes sole traders do register their name, a different name to their own, and you might see Anne Smith trading as TA, trading as something else. Okay, and that happens. So it's easy to do that. It's very cheap to register. It doesn't make you a company. You're still a sole trader, but you just have a trading name, and that's easy to do. I just do it in the company's office, even though it's not a company, and it's just a form filling exercise really. And once it's an acceptable name, you're allowed to use that name. Okay, so Anne Smith is the name of the business. Trading profit and loss account is the name of the document. Trading profit and loss account. I'll just put AC for account. Okay, put a line underneath it, and now the year that it relates to, we just say for, and very often you see YE, year ending 30th of June 2020, the period that it relates to. And everything's in money. Okay, so currency symbol. So as we saw already, it's just an equation. Revenues minus expenses. So our revenue we know already is the sales. So we put that in, it's 120,000. And now we're just going to work out the various expenses. So we do this calculation of the cost of sales. Opening stock, 8,000. That's the cost of the opening stock, the cost of what was purchased, the stock purchased, and that was 60. We'll add those two together, we get 68. And that's what could have been sold, but it wasn't all sold. We're only interested in the stuff that was sold, so we're going to take away now the closing stock. And we'll take it away, and it's 18,000. Now I know before I did brackets, but normally you don't actually see the brackets, so you just have to know that we're subtracting that 18,000 from the 68, and we get the cost of sales. Or cost of goods sold sometimes. So the cost of goods sold, 18 deducted from 68 is 50. Okay, 50. Okay, so right, so we take that away first. Okay, so we're taking away the 50 from the 120 and we get 70. And we give that 70 a name, and the name is the gross profit. It's not the real profit, it's just a difference between what you sold the stuff for, what you sold the stock for, and what it originally cost you, that same stock. Okay, and that part, this part of the document is the trading account part. Okay, that's sometimes what it's called. Now sometimes the whole thing is just called a profit and loss account, but it doesn't matter. Okay, so there's some other expenses, so what we do is we make a list of them now and we just call them expenses. Okay, so now remember that isn't it, the 50 is an expense though, that's why we deducted it. So the various expenses, let's just do it very quickly because we did it already. Wages, 40,000. So you kind of see that there's two columns of figures here just to keep it tidy, no particular reason for that other than to keep it, people can read it easily. 10,000 for the rent. Insurance is 1,000. The motor expenses, 2,000. The telephone is 1,000. The loan interest, not the repayment, remember, just the interest bit, that's the cost of borrowing the money, 900. And of course the depreciation is the expense, but as you know, it doesn't come out of the bank or anything. They don't pay for depreciation, it's just an accounting adjustment. So we've kind of got two accounting adjustments here. Okay, one is that when we take away the closing stock from the purchases, okay, we're not going to include that as an expense. That part of the purchases, 18,000 is part of the purchases. We're not going to include it this year because we haven't sold that stuff. That's an accounting adjustment. And now down here we've reduced the value of the equipment by 4,000 again this year, and that's an expense, and that's another adjustment. Okay, so that's all. Okay, so we add up all of those, get a total. What is the total? Sorry, I just have to get that over here somewhere. Okay, so when we add up all those expenses, they come to, gone too far. Okay, so we add up all those expenses, they come to 58,900. Okay, so that's the total of the expenses other than the cost of sales. We subtract that now from the gross profit, and as we know already, because we just calculated it in our equation earlier, the profit, or the real profit of the business, what we call the net profit, is the 11,100. Okay, so that's the end of that. So this document, if you like, measures how the business performed. How did our business perform during the year? Well, she made a profit of 11,100. Now you'll notice that I think last year's profit was much higher. Okay, even though the sales of the business in the second year, was 120. I think we said there it is there. And even though the sales went up by 50% from last year, because it was only 80 last year, the actual net profit went down. So that's something maybe Anne would like to look into. And I think the reason, of course, was that the wages are much higher than they were last year. I think that's the main reason. I think the rent is higher as well. So the expenses, because the expenses were much higher this year, it kind of outbalanced, if you like, the increase in the revenues. But anyway, the question is then, who owns this profit? Who owns the net profit that the business made, 11,100? And I think we know the answer. The answer is that Anne owns that profit. Okay, so she owns it, and therefore, what are we going to do with it? We're going to add it on to the capital. Okay, in the balance sheet, capital is money owed to Anne, money owed to the owner. So this net profit is also owed to her, so we're going to stick it onto the capital when we get to it in the balance sheet. Okay, let's do the balance sheet. So this is the next published bit. So again, we put the name of the business, Anne Smith. Okay, the name of the document, balance sheet. And we use this expression as at the date, 30th of June. Okay, I just don't have enough room, but I'll move it over a little bit so I can fit it in. 30th of June 2020. Okay, so that's that. Right, again, we know what the figures are going to be because we did the accounting equation. But let's put them in the proper order as it is in the balance sheet. So the first thing we're going to put in is the fixed assets. So we do a heading, because in this example there's only one fixed asset, but in other businesses there might be a list of what they might be, these fixed assets. There might be vehicles, vans or trucks or something like that, or there might be property or land or something. But in this case it's only equipment. So we're going to put in the cost. We're going to put in the depreciation to date, or aggregate depreciation. I'll just put DEP because I can't fit it in, to date. That's up to the date of the balance sheet. Okay. And the next one is the net book value. Net book value. And of course the net book value is just a value in the books, and how we calculate, okay, is it's just the cost minus the depreciation to date, and we put in euros symbols. Okay, so the first fixed asset, or the only fixed asset, is equipment, and we're going to show the cost, which is 20. Remember, it was purchased in the first year for 20, and now the depreciation to date, we have to put in 2 years depreciation. 4,000 and 4,000 is 8,000. Okay, and now to get the net book value, okay, we just subtract 8,000 from 20 and we get the 12,000, and we did that before. So the 12,000 is what we're really interested in. So we can put 2 lines under these figures here, indicating that we're no longer interested in them. We're only interested in the 12,000. So very often in these in a balance sheet you might only see the net book value and not bother with this stuff here. Okay, the next figures then are the current assets. These are short-term assets, or they're assets that are going to turn into cash shortly, or cash already. Okay, and we have stock and we have debtors. We said it is no longer money in the bank, so we're not going to put that in. So what have we got? Stock is 18,000, that's the closing stock. And the debtors, remember from the T account, 44,000. Okay, so that's not too bad. So that's our asset. So we add those two together and we get 62. Put a line underneath it. Okay, so now we have all our assets in. There's our fixed assets out there. Okay, our fixed assets are out there on the right hand column. We've 3 columns, you see, And the depreciation to date is the middle column there, and we're putting the current assets under that. It's nothing to do with depreciation, of course, again, just to keep it tidy and that it's not all over the place. So we're using the middle column for the current assets. But what we have is the fixed assets 12, the current assets 62. We don't add them together yet because we're going to put in now the current liabilities. So let's do that. Current liabilities. These are the short-term debts of the business. And we have creditors that have to be paid shortly. These are the suppliers, and they are 25,000. And the other one is the bank overdraft, which has to be paid shortly because because one of the rules of bank overdrafts is you have to get it into credit for 30 days in the year at least. So certainly before the year is out, they have to get this into the black, I suppose, out of the red and into the black. So it's 9,000. Okay, 9,000, that's right. And that's 34,000 in total. So we've got all our assets and our current liabilities. What we do next, of course, in a balance sheet is we're going to subtract the current from the current. We're going to subtract the current liabilities from the current assets, and it gives us a useful figure, I think we call this. I'll say what it is first. This is the net. We're going to calculate the net current assets. The net current assets. The difference between the current assets and the current liabilities. We're calling it net current assets. So we're going to subtract the 34 from the 62 first, and that'll give us 28,000. Let's squeeze it in here. 28,000. And that tells us something. It tells us something useful. How able the business is to pay its debts in the short term. So the short term debts, you can see, is 34. It has to pay that soon, within a year for sure anyway. And it has cash, or near, well, not cash, but near cash, 62,000. Like the 44, it will turn into cash as soon as the customers pay, and the stock will turn into cash as soon as we sell it and get paid, and so on. Okay, so we've 28. So this is called net current assets because the current assets are greater, but it would be called net current liabilities if the current liabilities were greater. But it's net current assets, so that's that. So we're going to add 28 now to the 12,000 net book value, and we get 40,000. Okay, no name for that really. The next figure we've got to put in are long-term liabilities. These are debts we don't have to pay for a few years, or most of them anyway. Liabilities. Okay, so what is our long-term liability? Well, I suppose it's the loan. Some of it we'll have to pay next year maybe, but the bulk of it we won't have to pay for maybe over the next few years. I suppose we'll pay it. So that's 5,900. So that's a liability, so we're going to subtract that, and when we subtract it we get 34,100. Put two lines underneath it, and we call that total net assets. Okay, total net assets. I just go down a little bit further and get a bit cramped here. So, okay, so that's that. Total net assets. Put a line underneath it, keep it consistent. So that's the left-hand side of our accounting equation. Assets minus liabilities, okay? And now the capital section. And when we're doing a sole trader's accounts, we very often just call the capital section, we use this expression, financed by. So we're saying that the net assets of the business are financed by the owner, financed by the capital. And we've done this calculation in the accounting equation already. Let's do it again. Opening capital, or opening balance of capital, opening capital. And I think we said it was 43,000. Okay, now this time I'm not going to calculate a retained profit because of course there's no retained profit. Because all the profit has been given, all the profit of 11,100 has been given to the owner, so we can't calculate a retained profit. So I'm just going to add that profit to the opening capital. So I just say net profit. is 11,100, and we're just then underneath that we're going to reduce the capital by the amount of the drawings, because the drawings are just withdrawals of capital out of the business by the owner, and that's 20,000 we said. And I will put a bracket on that because it wouldn't be clear otherwise that we're going to subtract. Okay, so what do? We just add those three figures up and we get, of course, 34,100. Okay, so that's our balance sheet. So there's our two published documents. Okay, the first one, the profit and loss account, trading profit and loss account, tells us how the business performed during the year. It's a measure of the financial performance of the business during the year, our profitability. Okay, the trading profit and loss account. And the balance sheet then is a measure at the end of the year of the solvency of the business, the assets and liabilities of the business, or sometimes referred to as the financial position of the business at the end of the year. In fact, sometimes the balance sheet is referred to as a statement of financial position. Okay, so they're the two documents. The other measurement that we made, of course, was the liquidity measurement, and we did this, which is not really published, it's not really highlighted. The only reference to it in the accounts, I suppose, is the bank overdraft figure there, 9,000, which is the end result, I suppose, the closing balance of our liquidity calculation, which was the T account for bank, and that's done. Okay, so that's basically that. Okay, so we've done the 2 years then for Anne's business, first year and second year, and the reason I did the second year, of course, was to show how the opening balances are incorporated into the calculations. Okay, so I think that's that. I think I'm finished, so I'll talk to you soon. All the best. Take care.